and welcome to the May Buy-to-Let Mortgage Market Update. Yes, we're there already. My name's Richard Purnell. I'm from the Mortgage Home and we're your buy-to-let mortgage experts. In this piece, I want to talk about interest rates. We've had now, I think 12, is it? I'm losing count. 12 consecutive Bank of England rate rises. We're now up at 4.25%. Date of recording is Friday the 5th of May. And we have a committee meeting next Thursday, the 11th of May. My predictions, and this has been consistent throughout the year, is that we will see a further rise from the Bank of England, highly likely to be 0.25%. And following that, I think there's a possibility, so really highly probable that we've got a rate increase next week. And I think possible we may have a further 0.25% rate rise in June, maybe July. After that, I think the Bank of England is going to park the bus on the basis that the inflation figures will really start to kick in and get passed on to consumers, and we'll see that reflected in lower inflation rate figures as we go through 2023. So that's where we are on that. In terms of mortgage rates, for the first quarter of this year, there was consistent reductions in mortgage rates across the board. We were all really pleased to see that. Now that's really stabilized. I said that in my April update, and that's pretty much the same. If anything, I'm seeing real modest sort of amendments, let's say, tweaks to the mortgage rates. But I'm talking 0.1, 0.2% maximum, and I'm being very generic here in my comments. So really sort of stable, and as I've said previously, landlords are now able to make those decisions. A lot of confidence in the market now to be able to go on and either refinance or purchase properties. So the challenge now for you guys out there who are on standard variable rate, and I believe there's over 1 million mortgage holders that are sat on SVR or tracker rates. Now, if you are thinking that mortgage rates are going to drop any further, I've already said my view is they've stabilized now. Yes, they've been dropping in Q1, but that's it. If you think they're going to drop further before you jump off the fence and make a decision to get into the lowest fixed rate out there, that time really has already happened. I said that back in April, and I do not see mortgage rates dropping any further. So really, now's the time to make that decision to come off, assuming you can move to another lender, assuming you meet all the criteria. If you can't, I'm going to be talking later today about product transfers, and that may well be a godsend for you guys if you feel you are in a bit of a corner. In this piece, I want to talk about lending at 80% loan to value. We're all used to lenders having a ceiling of 75%. That's almost the norm. Landlords certainly would usually be looking, particularly for the buy-in, to put a 25% deposit down if possible. I want to just focus a little bit on 80% borrowing, because this is a real segment within the mortgage market that is a barometer for property market values and where lenders think that property prices are going. If we just rewind a little bit back to September 22, we saw after Liz Truss and her legacy meant that property prices really got shaky and started to drop. And there was a few commentators out there saying, oh, this is the beginning of the end. Property prices are going to tumble. We're going to see 15, 20% drop in property prices. And at that point, what I was also seeing is lots of lenders withdrawing from this 80% market. And fair enough, a lot of uncertainty. They don't know what's going to happen to property prices. They're not going to take a risk. Why would they? So they pull those deals. So why I keep a finger on this particular pulse is that Accord, and they're not the only lender, we're now seeing a trickle of lenders coming back into this market. So that's where I think this is really good, really positive news for landlords. The message we can take away from this is that the banks, the lenders out there are feeling confident that property prices are stabilized now, and therefore they can come back into the 80% market. So Accord, one example, literally just this week, they've now relaunched back into this market. They were there last year when Liz Truss and Crazy Quack 10 launched that mini budget. Accord pulled the deals at 80%, and now literally they've come back this week, and they are one of, as I say, a number of lenders that are doing that. On this particular deals that they've got, both 2-year and a 5-year deal, 5.39 and 5.29, whether it's a 2-year or a 5-year fix, which I think is a really good rate. As I've said previously, you've got to look beyond the rate. What are the fees they're charging? Because sometimes lenders are trying to give you some great headline rates, but then the arrangement fees are eye-wateringly high. Accord, no, not at all. 995, that's probably as low as you're going to get. So just about £1,000. It's a fixed fee. So again, the higher you're borrowing, the lower, relatively speaking, those arrangement fees tend to be. And for reasons that only the marketing department of Accord can explain, they're charging you £1,000 and they're going to give you £500 cash back. So go figure, but that's obviously a marketing ploy there. So actually it's a net 500 quid arrangement fee. So pretty good deal, I would say. But the message is more wider than just Accord by saying that the high street banks and the experts, economists and people that really monitor property fluctuations, trends and valuations are seeing that it's absolutely stable and we're back to sort of normal sort of property sort of figures. Now, lenders that are active at 80%, again, this is just a snapshot in the last few days. If you are buying or refinancing in personal name, we've got about 18. If you're in a limited company, we're at 7. So again, that trend is, as I said, is an upward trend. So I'd expect over the next month or two, even more lenders coming into this market. So fantastic. If you're looking to buy, and you think, well, I can get away with a 20% deposit instead of 25%. If you were buying at £200,000, for example, then that's £10,000 you can keep in your pocket. That's a pretty big chunk of change that you can use for your own purposes, that you can use on improvements, etc., etc. So not to be sniffed at. But here's the paradox. Here's the thing. Most lenders that portfolio landlords will be talking to and hoping to lend from are not high street banks. They are what they call non-banking lenders, specialist lenders, and they are predominantly, and I just want to underline this, not all of them. So this can be a get out of clause that I'll come back to in a second, but the majority of them are regulated by an authority called the PRA, the Prudential Regulation Authority. The point I'm making here is that it's this authority that are dictating to the specialist lenders, the lenders that you guys generally go to, about the rules and the due diligence and the tests and checks that they have to make on you as portfolio landlord. So here's the important point. That when you are, say, purchasing a property and you're thinking, I want to put 20% deposit down. So the lender's dangling this carrot saying, I've got an 80% mortgage that you might be interested in. The lender is duty bound to do some background checks on your portfolio in the background. And if the aggregate loan to value on the background portfolio is over 75%, is the irony, you're highly likely to get declined. Go figure. So hence I'm saying this is a paradox. We've got lenders saying, oh, go on, take one of our 80% deals, very competitive. But if your background portfolio in aggregate terms seems to be exceeding 75%, and they'll include the one, if you're buying one at 80%, that'll probably get added to the figures as well. So it's going to push the overall aggregate up a little bit more. If that's over 75%, that is deemed unhealthy, and you're likely to get declined. So the one final point, if you're, as a landlord, that you are highly geared, and let's say you are on average above 80% or above 75%, my apologies, there are a few of these specialist lenders that are not regulated by the PRA. And so as a broker, we should understand that if you go into a specialist broker, and if you come to us with that scenario and your background portfolio is highly geared, then really we're going to be knocking on the doors of this small number of lenders that are not regulated. So there is still potentially a way forward, because these that are not regulated have got discretion to still approve you. They still possibly take a look at your background portfolio, but it's not as strict as those that are with a PRA. So if you are looking at putting a 20% deposit down, you want us to look at your background portfolio, there'll be a link to our online diary. Just have a chat with us. There's no obligation, no commitment, no cost. Have a natter, see if you'd still be eligible, or if any of this might affect you, and we'd be happy to help. Okay, in this piece, I want to talk about product transfers. The headline says it's a coming of age for these fellas. Now, again, I want to go back to September 2022. It's etched on my forehead. Liz Truss, thank you so much for everything you've done for the property and mortgage market. The ghost of Liz and Mr. Kwarteng are still wandering the corridors and causing issues. Because back in September 2022, after that mini budget was launched, what happened almost immediately is that mortgage rates increased significantly. They went up by maybe 50 to even 100% increase over, I would say, a week, 2 weeks maximum. So massive issues. Linked to that, what that meant in practical terms, not only is the rate higher, but when you approached a lender and put your application in, whether it's for refinance or a purchase, the stress tests had to be at a higher interest rate. And many landlords were being told by us as brokers that you failed that stress test. The rents weren't strong enough to service the mortgage payments at this artificially considerably higher interest rate. And simply that's because rates have gone up overnight. Rents are going to take a year to 2 years to catch up. So you've got this lag. And in the meantime, that's the practical issue, that you guys couldn't refinance, couldn't release equity, couldn't come off your deal to go to another deal with another lender because you were failing these stress tests. Now, where do product transfers come in, you ask? Well, first thing to say is that all banks and all building societies will offer a product transfer. So if you're coming to the end of your fixed deal, for example, then the advantage of a product transfer over refinancing from lender A to lender B is a number of things. But the first thing is, on general speaking, no stress tests. So we sidestep that big issue I've just described a couple of minutes earlier. They won't check the rent to the new mortgage payment. They've already got you as a customer, so they're highly likely to offer you that next best deal. Linked to that, there's no credit checks. The only caveat I'd say to that is if on the security property and the mortgage attached to that, you've had arrears, or you currently have issues with late payments, then I think they're going to veto you your ability to get a product transfer. But I'm assuming that is a real minority of people. So for the vast majority of us, we should be offered a credit check. Now, what I also notice as a broker in this arena is that most lenders keep a track of what they perceive as the valuation of your security property. And we get an option as a broker and you as a landlord to take that valuation or challenge it. So what I have seen on a number of occasions are lenders' perception or their version of what they think the value of your security property is can be higher than the reality. And if that's the case, it might actually mean that when we check that, and as a broker, quite often we can talk to the lender or we can log onto the systems and see in advance what that valuation figure is. And if it's higher than what you thought it was, then from a loan to value point of view, it might drop you into a lower category and give you access to even cheaper deals. The final thing is about speed, because when you refinance to another lender, I would say to our clients, you should be building in or starting an application about 2 months before you come to the end of your deal. That's nice and comfortable, allows for some delays or any sort of small sort of bumps in the road. But 2 months before you come to the end of the deal is fine. But of course, life gets in the way, and we're often getting calls from our clients with weeks to go, sometimes days to go before they come to the end of the deal. And of course, once you come to the end of the deal, it's highly, highly likely that the interest rate is going to increase, and therefore your mortgage payments are going to significantly increase as well. So the advantage of a product transfer is speed. We can get you across to that new deal very, very quickly. Like I said, the valuation is already probably on the system, so the lender doesn't have to do another valuation. We're not doing any credit checks. The documentation requirements are very minimal, and there's no solicitors involved. So moving you from at the end of your deal onto the new one, so minimizing any those increases can be really sort of crucial. The one thing I'd say about all this is that the product transfers is on one big assumption. So I should underline this point, that this is on the basis that you're not looking to borrow any extra money. So product transfers are designed to move the existing debt across onto the new deal. So please bear that in mind. Now, final point, I've talked about all banks and building societies offer this. So this is my tip. This is my takeaway point. So you might want to make a note of this. Most portfolio landlords will have to knock on the doors of secondary non-bank lenders. And whilst the majority of them will offer product transfers, some do not. Underline that, some do not offer product transfers. And that's because their model with some of these lenders is that once they get a number of mortgage deals through the door, they package that up and then they sell the mortgage book onto another lender. And that can be within 3 months, let's say, or 6 months of you coming on board as a new customer. So the intention is you shouldn't be with that lender in 2 years' time or in 5 years' time when your deal ends, because they've sold you on. So they've never thought of putting product transfers in place. But the market has changed, and now a number of these lenders, and that model isn't as robust as it was, and they're not being able to sell on the mortgage book. So now they're retaining it, and they still don't have any product transfers to offer. So you might be coming to the end of the deal, and let's say that there are issues with your credit checks. Let's say you don't hit the new stress test calculations, and therefore you're not also being offered a product transfer. You're essentially a mortgage prisoner. Your only option is to go on to standard variable rate, and that will be significantly higher. So the takeaway point here is, if you are coming to the end of the deal now, for example, and you're looking to move to another lender, let's say, and your broker is offering you an option of a brand new lender at that point, then I would say that you should be talking to your broker about the new lender that's been recommended and whether that new lender has product transfer. Because if you're going to move to this brand new lender, then having one eye on whether that new lender has got product transfers or not, for me, is now becoming a more important point that you need to understand as a landlord. Now, it might be that your broker's offered this new deal with a new lender, even though it doesn't have a product transfer. It may well be the right advice for you. I'm not saying never ever go to what a broker's recommending if it doesn't have a product transfer, but you need to be mindful, because you are potentially kicking that can down the road if that lender does not have a product transfer. And it might be you say to your broker, okay, well, what's the next best lender that does have a product transfer? And if the difference is really marginal, then there's a decision to be made. You might actually want to pay just a fraction more on the rate or a fraction higher on the fee to go to a lender that will have a product transfer, because they are now becoming more and more important as an option on the table for you as landlords. I'm hoping that made sense for everyone. If it resonated with people come to the end of the deals and want to understand about product transfers a little bit more, then there will be a link at the end of this piece to our online diary system. Book some time with the team, have a chat, no obligation, and we'll see if we can help. In this piece, I want to talk about the holiday let market. I've said here, it is boom time. I read a report by Sykes Holiday Cottages in the last week or so. It's their annual report. Now, some of you will know who Sykes are, some of you will not. Now, Sykes, for those who don't know them, they've got 22,000 holiday lets on their books as agents. So I don't know if they are the largest holiday let agent in the UK, but if not, they must be there or thereabouts. And looking through their annual report, I just pulled out a little bit of data that I thought for you guys that are either thinking of getting into holiday lets or looking to expand your holiday let portfolio, then it makes for really interesting and in fact exciting reading. So here's some of the sort of key stats that caught my eye. Now, the figures you can see here, first of all, I want to say what's the comparative data. So what Sykes did was they looked at the last full year before COVID got involved. That was 2019. And they compared it to 2022. So those are the two comparable years that they are full years without the impact of COVID being involved at all. And as you can see here on my slide, is that bookings were up 48% across those 2 years. Huge, significant figure. What I think is even more important than the number of bookings is the revenue. What's the turnover that was generated? It's gone up by 50%. And this is per holiday let. This is on average per holiday let. The revenue from 2019 to 2022 increased by 58%. Now, an old friend, an accountant of mine, once said it's not how much money you earn that matters, it's how much money you keep. So this is turnover. This is the top line figure. So there are still, of course, costs involved in running a holiday let, but my word, an extra 58% on the top line is a tremendously positive sort of start to the revenue that you're going to get on a holiday let. They've also had a quick look at 2023 because, okay, well, that's fantastic, Richard, you might say. And maybe you think, well, that's a sort of staycation hangover after 2021, where people are still a bit nervous about going abroad. And I think that's a fair point, that the ripple effect of staycationing and one not being allowed to go abroad or people now thinking they might stay in the UK may well be continuing. So Sykes have looked at 2023. Obviously, we're only into May already, but looking at the comparable year just from 2022, first few months of 2022 to the same months in 2023, there's a further 9% increase year on year revenues. So it wasn't just a one-off. It's not dropping back down as everybody's going back out to Benidorm again. There's a continuation. You would expect it to drop. Of course, you can't expect a 58% increase to continue year on year, but the fact that we're seeing a 9% increase between 22 and 23 is a really positive point as people now are maybe reigniting their love for the UK. They're looking to obviously have holidays. Maybe they're cheaper holidays as well. We've obviously got the cost of living issues going on there. So if people are thinking that it's cheaper to holiday in the UK, then I think there's a little bit of that going on there. Another point that I picked out of this report is that Sykes are seeing there's more of a trend away from longer breaks to shorter breaks. And again, as I said, we've got 10% plus inflation, food prices going up significantly more than that, energy prices, we all know about that. So there's this shift towards maybe more long weekends than 1 to 2 weeks. So although that might be worrying, the fact that overall revenue is up, I wouldn't be concerned about that. And if you're looking to go into holiday lets, then the way that if you're not giving that to a professional agency, then you're looking to manage it yourself. Then I think the way you're pricing, clearly you've got to weight your pricing over those weekend days. It looks obvious, but this piece of statistic, reinforces the need to get your pricing sorted properly. One thing that really scratched my head on here, the main reason for buying a holiday let, the top reason, 52% of people buy a holiday let because they can use it for personal use. It throws me a little bit that. I get that some people might have a holiday home, but therefore it wouldn't be with Sykes, would it? So it must be for investment purposes. It's got to be for revenue generating purposes. And that would worry me a little if our landlords were buying a holiday let primarily for personal use, because that suggests to me that people are buying with this thing. They're buying with a heart, not with a head, and therefore people might make the wrong decisions. They might be buying in the wrong area that's not necessarily optimized to maximize revenue. And from my perspective, as a portfolio landlord, as a landlord that's got holiday lets, my view is if you buy a holiday let purely with your head, purely on objective data that's financially going to get you the best returns and puts more money in your pocket, that gives me more profits to get holidays where I want. If I'm not using that holiday let for personal use, I can rent it out, take the money and holiday wherever I want instead of being locked into one place. So I'm really puzzled a little bit by that logic. Now, linked to that, they've also taken a look at what are the up and coming areas? What are those areas around the UK where they're going to offer the best longer term investment returns? They've looked at trends of demand. They've looked at what are the current property prices right now, and is that good value for money? What have been the trending property price increases, and correlated that by postcode. And these are them in order. So who knew? Cheshire has come out top of the list. We've got Anglesey, obviously, just off the coast of North Wales. The Lakes, now that's an interesting one. For me, you've got to be really careful about that. You've got the Lake District National Park, of course, which is pretty much overcooked. The property prices there are significant. So I'm wondering whether they're thinking that's more in the wider Lakes and Cumbria area, maybe more around the M6 area. We've seen a few landlords buy just outside the park, but close proximity to it. Carlisle area, for example. Certainly seen a few of our sort of clients looking in that area. We've got one area over the border up in Scotland. Of course, that's licensed now, so you've got to bear in that in mind that there's more hurdles to jump through. But I've got a feeling I'm going to be talking about that in England in the not too distant future. We'll keep that for another day. And then Norfolk and back to Wales again, back in some sort of in Pembroke area. So some interesting points about the top 7 areas that Sykes really see based on the data that they have that are the sort of good sort of buying areas. So that I'm hoping that will be of interest to you guys that are buying holiday lets in 2023. The final point I want to make on this holiday let section is on the tips that Sykes are saying will help you to push revenues above the average. Might not be surprised to hear hot tubs. Add an extra 37% to the revenue compared to a very similar property, comparable property that doesn't have a hot tub. That's the curb appeal. That's the extra bang for your buck you're going to get for investing in a hot tub. Now, remember, 37% is on turnover. There is maintenance, and you've got to be really careful. I know a number of our landlords that have got hot tubs, and of course, keeping them absolutely squeaky clean, having a great maintenance contract, having them cleaned, maybe emptied on a weekly basis is really, really important. You get that wrong and you're going to get those bad reviews. So make sure that you've got your systems in place to manage that particular feature really well. but 37% increase to the revenue. So certainly if you've got room for a hot tub, I would seriously consider having it one put in. Another point, again, maybe not surprisingly, having it pet friendly. Don't ban the pets if you can. Adds another 31% to the turnover of your holiday let. And the other point on here is Wi-Fi. Now, so adding 26% of revenue. Okay, I didn't know that there might be some properties that that might not have Wi-Fi. You'd think the vast majority do, but if you don't, or you think, well, that's an extra cost to me, you could be losing out on 26% revenue. So some really interesting points that Sykes brought out here, and hopefully that is of use to you guys that I say that are thinking of buying holiday lets. And if you are, and then you want to have a chat with us about what do the mortgages look like, because the mortgages are different for holiday lets than a traditional buy-to-let. So you need to be chatting to a broker that does understand the difference, how are you going to be managing them, and what the projections are likely to be. Then all that links into the types of mortgages that you can get for a holiday let property. So again, if you want to have a chat with us, have a click on the link that we're going to get put at the end of this piece, and we'll be happy to have a chat and give you our advice. In this piece, I want to talk a little bit about life insurance for our portfolio landlords that are still active in building their portfolios. Now, we had less than a week ago, we had a phone call from the partner of one of our long-term clients and friend of the company. It was devastating news. It was a call that we took over the weekend to say that this long-term client of ours had had a sudden illness and had passed away. And it was a desperate situation, obviously, for the partner that had been left behind. There's 2 children involved as well. This lady were in her 40s. And like I say, she was a real friend of the company. We'd known her for a number of years and helped her buy a number of mortgages. And she was the driving force in building the portfolio up and achieving her sort of property goals. Except now, those plans are by the wayside. They're in pieces. And so I thought it's really relevant that as a broker, I'd really bang the drum and get the message across, because, you know, this is yet another example for us as a company, seeing our clients and their families devastated when these things do happen. And they do happen. They do come out left field, really when you're not expecting it, and devastate lives in so many ways. But financially is one way you can mitigate against that. And so I make no apologies for banging this drum again. So in particular, I think our landlords are vulnerable, as this client was, whilst you're building your portfolio. The aim for this client, as with many, is to build a portfolio to get to a level where they can retire early, where they can get their passive income stream to a level where they are financially independent, where that money will come in, rain or shine. And absolutely, at that point, there's a really good argument for saying I don't need an actual insurance policy, because the portfolio itself and the income acts as an insurance policy. So I get that. But you're vulnerable on the journey. When you haven't got to that level of passive income stream and something's going to go wrong, that's where you want the insurance policy in place for. So if that was to happen to you, how would you cope? What would the situation be? Would there be enough passive income coming in right now for your family to keep the roof over their heads, to give them the financial lifestyle that you wanted, to have that financial independence? For pounds a month, and it could be, you know, if you're healthy now, 6 or 7 quid a month gets you £100,000 of life cover. It is extremely cost effective to put in place and mitigate what would be absolutely devastating to the family if happened. And so if that does happen, the life insurance can kick in, repay all these buy-to-let mortgages. So yes, you're not perhaps going to be buying any more properties, but of the ones that you've got, you're going to be retaining the vast majority of the rental income, and therefore that accelerates you to your financial goal of independence, of achieving that level that you wanted for the rest of the family. So as a legacy for the person that's no longer here, then at least those goals are still realized. That's why it's really, really important that you review this, you make sure that your policies are fit for purpose. And if you're unsure, then have a chat with the team. We've got an insurance expert in Yvonne who will give you the figures, give you the information so you can make an informed decision about whether what you have got is spot on or whether you need to tweak what you've got. In some cases, we find that some people actually over-insured, and you can actually reduce the cover, reduce the premiums, and even put a bit of money back in your pocket. You never know. So put a little bit of time and invest in that time just to check that out. And again, there's a link at the end of this piece. Click on it, book some time in with Yvonne, our insurance lady, and she will put you on the right track. Here is that link to our diary. So take a screen print, take a photo of it, and you can follow that link through whenever convenient and book a bit of time and speak to the team. If it's something that's really, really urgent and you can't get an appointment for a number of weeks, ring the office. We will do our damnedest. We always have a little bit of capacity in the background. So if there's those urgent appointments, we can get you booked in, hopefully within a few days, so that if you come to the end of your deal, you're not going to go on to SVR. If you're buying a property, you won't miss out on that next best deal. Other than that, here's a list of all the properties of all the services that we provide. So anything secured against bricks and mortar, we'll be happy to help. And of course, life insurance, income protection, critical illness is also our bread and butter. Other than that, have a great month and thank you for watching.